time to start. I think it has started, okay?
Yes, ma'am. It's recording.
Yeah, it's recording. I don't know, there is some problem. It is not taking the content. Just give me 2 minutes. Okay, now I think it is visible to you all. Just
Not,
respond. Is it?
not visible yet, ma'am.
No, it is not visible.
Yes, ma'am. मैं तो मैम ग्रुप में ही हूँ.
It's not.
मैं अल्पा बोल रही हूँ मैम. अच्छा ठीक. ओके मैम. इट्स ओके मैम. Is it visible now?
Yes, ma'am.
Yes,
Yes, ma'am.
yes.
I instead of uploading the 9th one, I have uploaded the 10th one. This is the basic difference. We need to upload block 3. What you are saying, what is there in your screen? Block 3? Is it block 3?
Hello, ma'am. Yes, block free application of cost
Yes, ma'am.
accounting.
Okay, now we can start. So thank you for your patience. There was certain technical glitch. Now it's solved. So we are going to now start application of cost accounting. I hope everyone knows what is application. Application means the use of cost accounting. So when we talk about the use of cost accounting or the application of cost accounting, we are going to understand this application with the help of three units. Yesterday we have done till 8th unit, and now it's the ninth chapter, or whatever you call a unit. It is the cost, volume, profit analysis. Next, it will be variance analysis. And the last one, it is budgeting and budgetary control. So when we talk about cost, volume, profit analysis, it means that we are going to analyze the profit. We want to find the way that how changes in variable and fixed cost affect the firm's profit. Yesterday we have learned what is fixed cost, what is variable cost. Now when we add variable cost and fixed cost, it is the total cost of the firm. And when we talk about the total cost of the firm, we also need to know how this total cost is going to affect the profitability of the firm. So cost, volume, profit analysis, it is a way to find out how changes in variable and fixed cost affects a firm's profit. Any change in the fixed cost or any variation in the variable cost, both are going to affect the firm's profit. So companies can use cost, volume, profit to see how many units they need to sell to break even all the cost so that they can reach to a minimum profit margin. I'm again repeating what it is said. The company needs to find out that what should be the volume of units they need to sell so that they can reach to the minimum level of profit. So when we talk about cost, volume, profit analysis, it is the total cost of a firm. And the total cost of a firm, it is inclusive of fixed cost and variable cost. So any change in your variable cost or any change in the fixed cost, it is definitely going to bring a change in your total cost. And when the total cost changes, automatically there is a change in the profitability of the firm. So how much this change brings a change in the profitability? And the second important aspect that we are going to take care is that how we can increase this profitability. So we know what is absorption costing, we know what is marginal costing. Can you recall what is absorption costing and what is marginal costing that we have done yesterday? Just let me know what is marginal costing and what is absorption costing. Yesterday we have done in block 2. Because when we talk about absorption costing and variable costing, this again we are going to repeat here also in cost, volume, profit
Ma'am,
analysis.
mm, yes, ma'am. Marginal costing, it considers variable costs, direct costs of producing.
Please, can you repeat the question?
Hello, ma'am. You are not audible to us.
Is it clear now?
Yes, it's clear.
Okay. So I'm just repeating again. Volume analysis, it is a way to find out changes in variable and fixed cost that is going to affect a firm's profit. So any change in variable cost or in fixed cost, it is definitely going to affect the firm's profit. So the companies can use this cost volume profit analysis to see how many minimum units they need to sell so that they can break the break even point. And when we break the break even point, we can cover all the cost to reach to a certain minimum of profit margin. So this cost volume profit analysis is all about what should be the minimum units we need to sell, how we can, what is the minimum unit or how we can overcome this break even point so that all the cost is covered, and if there is a change in fixed cost or variable cost, how it is going to affect the profitability of the firm. So when we talk about the cost volume profit analysis, the main components of cost volume profit analysis are the ratio of variable expenses and fixed expense, the break even point, margin of safety, changes in net income, and degree of operating leverage. When we talk about degree of operating leverage, we need to find that a single unit of change in the sales, how it is going to bring a change in the profit. Operating leverage, leverage is profitability, and operating leverage is your net profit, which when we take out our net profit, operating profit, or earning before interest and tax, we need to find that without using the fixed finance expenses, if we use only fixed cost, then how we can calculate operating leverage. So if we come back to our content, here is the structure. You can see the structure. It is the introduction, then what it is already I have explained you, the impact of factors on profit. We have marginal cost and contribution. Both we have done in the previous class also, what is contribution and what is marginal cost. Then few self-assessment questions with keywords. So introduction part I have already done. You can see here it is written cost volume profit analysis. It is an attempt to measure the effect of changes in volume, cost, price, and product mix on profits. Any change in volume, volume is units, volume is quantity. So any change in volume, any change in the cost, any change in the price, and the products mix, how much it is going to bring a change on profits. So these all factors are interrelated. For example, cost vary due to choice of plant, scale of operation, technology, the efficiency of workforce, and management efficiency. For all these reasons, you can see there is a variation in the cost. If you want to have a plant situated at a very prominent place, the cost of the plant will be more. If you want to go for large scale operation, the expenses will be more. Use of modern technology, you have to pay more. So we need to find out that with the variation of all these factors, what is the change, what is the effect in our profitability. So this is the diagram. It is a decision model where managers employ to choose the alternative courses of action. So you can see the model. It is sales. From sales, if we minus, this we have done yesterday also. From sales, if we subtract marginal cost, the answer is contribution. From contribution, if we minus fixed cost, the answer is profit. And this profit is leading to profit graph and break even chart and CBP formula analyze. So any deviation of cost into their variable or fixed cost of course, will bring a change in the total cost. If here your fixed cost changes, your profitability will change. If here your marginal cost changes, then it is going to affect your contribution. Again, this is your variable cost. Now, next it is interplay and impact of factors on profit. Cost and volume do influence profit, this we know. So we can observe with this that the extent and nature of this impact, if we go with this illustration. How price changes on net profit. We will also analyze how volume changes on net profit, price and volume changes on net profit, an increase or decrease in variable cost, an increase or decrease in fixed cost, and all four factors that we have seen, it is the price, volume, variable cost, and fixed cost, how it is going to change your net profit. So this is an illustration. The normal sales volume is 2 lakh rupees. Units at a selling price of rupees 2 per unit. Capital investment is rupees 2 lakhs. And management expects to earn a fair return on it. Fixed costs are rupees 1,60,000 and variable expenses or variable cost is rupees 1 per unit. So when we say it is variable expenses, it depends either on the volume or on the percentage. The control column of each table shows normal volume, decrease in volume price by 10% and 20%, while an increase in volume price by the same percentage. So we'll come to this solution. So this is the particulars. We have seen what is the units, 20% decrease in price, 10% decrease in price, then normal volume, and then increase 10% and 20%. These are the three different situations. We have units same. Units are not going to decrease or increase. So units 2 lakh, it remains same in all the situations. So if it is sale, for the first situation, sale is 3,20,000. Now how this sale is 3,20,000? 3,60,000, 4 lakh, 440 and 480. What they are saying? At a selling price of rupees 2 per unit. So total units are 2 lakh. Total units, I hope it is understandable. Total units are 2 lakh. So 2 lakh into rupees 2, what is the sale price? 4 lakhs. So in 4 lakhs, the first situation is 20% decrease in price. So 20% of 4 lakh is 80,000. So 80,000 minus 4 lakh, your answer is 3,20,000. Then if it is 10 lakh, so 4 lakh ka 10% is 3,60,000. Normal, you can see it is 4 lakhs. When it is normal volume, the variation will be either decrease or increase. If it is increase, it will be moving upward from the normal volume. And if it is a decrease, then it is going to be downwards. So 10% of 4 lakh is 40,000. 4 lakh plus 40,000, it is 4 lakh 40,000. And next it is 4 lakh 80,000. Variable cost is fixed. Variable cost is 1 rupees per unit. So units are 2 lakhs. So variable cost is also 2 lakh in each case. So what is the marginal income? Marginal income is sales minus variable cost. Marginal income is sales minus variable cost. In this marginal income, we add fixed cost and then the answer is either net profit or net loss. Am I clear? Just go through this. Is this visible to everyone?
Yes.
Yes, ma'am. But
Yes,
Please go,
ma'am, is busy.
try to understand. I hope everyone is with your registers and pen pencil. Yes, now the question is also visible and the solution.
Excuse me, madam. Cell cost. The one is okay. The percent of what? 20% of what cost? I want to understand the
Gura, can you repeat, please?
cell cost under the line of unit.
This
Cell
sales
cost.
rupees.
Yes, it's the 20% of what?
It is not 20% or 10%.
Yeah.
Sales is calculated on the number of units that is produced. You can see in the question what it is written: normal sales volume. I said volume is what? Units. Volume is the quantity. So how much units you are producing or selling? It is 2 lakh units. Okay, so 2 lakh units and the selling price of each unit is 2 rupees. So if you say what is the sale price or sale amount of 2 lakh units, so it is rupees 2 multiplied by 2 lakh. The answer is 4 lakh. Am I clear? So when we talk about
Yes.
normal sales, the normal sales is 4 lakhs. Can you see here normal volume? Below this normal volume, it is written 4 lakhs.
Okay.
Okay, so normal volume is 4 lakhs. It is the sales per unit multiplied by the total units. Now, the variation that you need to find out, it will be either decrease or increase. So, if we go with decrease, it means the value will be less than 4 lakhs. So, first case, it is 20%. 20% of 4 lakh is how much? 80,000. So 4 lakh minus 80,000, your sale amount is rupees 3 lakh 20,000. Same way, in the second case, it is 10% decrease. So 4 lakh, 10% is 40,000. So 4 lakh minus 40,000, the sale amount is 3 lakh 60,000. In the same manner, if we come to the next one, increase in price, when it is decrease in price, we subtract. When it is increase in price, we add. So whatever is the percentage variation that we are going to add in the normal volume. I hope it's clear now.
Okay, thank you.
Others also, please go through it. Where is Chipulu Matsu today? Chipulu Matsu, are you there in the class today?
Yes, ma'am, I'm here.
Are you calculating?
Yes, surprisingly, it's easier today. I'm following.
It is the same which you are following?
Yes, it's easier today. I'm following. I
Oh,
understand.
oh, oh, it's my
I
pleasure that
fully
it has been
understand it.
easy for you today. Okay,
Thank
go
you.
ahead. Once it is done from your end, just let me know. Is it done? Can we move to the next?
Ma'am,
Yeah.
I have issue on the break-even point.
What is the issue, Usman? You are in an environment which is noisy, so you have to find the solution for this, Usman. How can I help you out in this matter? You just move your place to somewhere else. Come out from that area.
Hello, ma'am.
Yes, Usman.
Yeah. So please, can you repeat the?
What you
I
want me
have
to repeat?
technical break-even point.
Break even, I have not come
And,
to the break even point. Break even, I will explain later. First, you come out with this.
okay,
How there is a variation in the
okay.
variable cost and fixed cost. I have not yet started with break even.
Okay, I got it.
Where are you? Why so noisy it is? Are you in your office?
Yes, ma'am. I'm in the office.
Okay. If you can close your doors or switch off the fan, I think it will help you.
Okay, I'll
Or
do
else
that.
you can use the or else you can use your earphone or headphone, okay? Okay, so I'm coming to the next. It is done from your side. This is profit graph. You have to depict the profitability in the graph. So this through the content only you can do. This is how it is depicted, the profit, loss, fixed cost, variable analysis. Is this graph clear?
But we are not hearing when you are explaining the graph. You are muted.
No, I am unmuted.
I mean, when you are explaining on the graph,
Okay.
you are not audible to us.
What I said is this is the depiction of the graph, y-axis and x-axis. As you can see here, this is the profit, the upper portion, it is the profit, and here it is the loss. Okay. So when we talk about any change, if it is a profit, of course, it will move up. So this is the break-even point. Break-even point is the medium where your sales is equal to your cost. I hope everyone knows what is break-even. Break-even is where your sales is equal to your cost. So if you revise the profit as a result of the drop in sales or volume, there will be a drop in the sales volume. If a drop in sales volume is there, there will be a drop in the profit also. So this is not so important. Okay, this is only for your understanding. I have seen over the years in exams, while writing the paper, the depiction of this graph is not asked. You have to only say how it works. Am I clear? In practical, graphical representation doesn't come. Okay.
Okay.
Now we come to cost segregation. Cost segregation, what does segregation means? How to find a difference. Okay, taking it away, segregation. We want to note the difference. So some broad guidelines which are suggest we need to divide the cost into two dominant, and these two costs are fixed and variable cost. So cost that remain invariant to the volume of activity. Invariant means which does not affect to the volume of activity. Whether you are producing 1 unit or you are producing 1,000 units, the cost remains same. So the cost that remain invariant does not varies to the volume of activity. It is considered fixed. So no costs are fixed forever. The concept is relative to the planning horizon, usually a short run one, and the relevant range of activity. It is only a planning for short term. We know that no cost is fixed. It may be fixed for a certain extent, but if continuously there is an increase in the volume, the cost needs to be changed. Costs that vary in direct proportion to the volume of activity, this we know it is classified as variable cost. So costs that otherwise belong to a mixed category, that is, which neither belong neatly to category A nor to category B, in fact be appointed to one of the two categories, fixed or variable. So when after a certain extent the fixed cost also changes, such cost may be for initial time it will be in the fixed cost, and later on when it changes, it varies, it will be put into variable cost. So this, if a mixed cost varies in some proportion to output or volume of activity, it will be classified as variable cost. And on the other hand, if a mixed cost is predominantly fixed, it would be classed as a fixed cost. So depending on the nature of the cost, we try to find whether the cost is fixed cost or variable cost. Am I clear here? How cost segregation is done, how to identify which one is fixed cost and which one is variable cost? Because you are going to get a question on fixed cost and variable cost for sure. The class is very silent today. I don't know why. Where is the energy today? It is weekend, so it is drained.
It's okay, madam.
But you people are very silent today. Why? Today you had two classes. That's the reason. You had a class in the afternoon also.
No, ma. Please, ma. We need you to please re-explain the cost picture.
You again want me to explain this cost segregation, Hosseini?
Yes, ma.
Cost segregation means how to identify the differentiation in cost, how to identify which one is fixed cost and which one is variable cost. In order to identify the fixed cost and variable cost, a very simple logic you need to apply. The first thing, that the cost that remains constant, it is not going to change with the volume or quantity of operation. That cost is fixed cost. And variable cost, the cost which keeps on changing with the direct proportion to the volume of the activity. Like for example, for producing 1 unit, you require 1 unit of, say, a product, you require 2 units of raw materials. If you prepare 2 units of product, then you require 4 units of raw materials. 3 units of product, you require 6 units of raw material. So with the change in the volume of the activity, the requirement also changes. To produce 1 unit, the cost is 2 rupees. To produce 2 unit, the cost is 4 rupees. To produce 3 units, the cost is 6 rupees. So per unit costing is 2 rupees. But this change of cost 2, 4, 6, this is your variable cost. That with the change in the proportion of your with the change in the volume, the proportion of cost also increases and decreases. But when we talk about fixed cost, the fixed cost means whether you are producing 1 unit or 10 units or 100 units or 1000 units, the cost remains same. You can take the example of a salary. When we pay salary to a person for maintenance of office, whether in the office the production is for 10 units, 100 units or 1000 units, the salary is fixed for his month. But when it comes to wages, wages are paid to laborers. So we are going to pay laborers wages only in the case when there is a production, when there is a production or manufacturing. If there is no production, no manufacturing, we are not going to call that labor and pay wages. So this is the basic difference of variable cost and fixed cost. That fixed cost never changes with the change in the volume, with the quantity, with the units. But variable cost keeps on changing proportionately with the proportionate change in the volume or units. Am I clear now?
Yes, ma.
Yes, yes, very clear.
Okay. Now, how to we these are few methods how to segregate cost. Cost may be semi-variable cost, fixed cost, and variable. In the concept, in the cost of variable cost, there is a semi-variable cost also. Semi-variable, it is fixed for variable for some time and later on it is fixed. We all know that when we increase the production, the cost at lower unit is more, and when we go for large scale production, the cost also changes. So these are the semi variable cost. So there are two statistical datas. When you will come to statistics, you will learn this. One is least square and one is scattered diagram. These are the two methods through which we try to segregate cost. Anything which is directly associated with your production is variable cost, and the one which is not directly associated with the volume of production is fixed cost. Now this we are going to study again in your this unit. It is your marginal cost and contribution. In the last class also we had gone through this marginal cost and contribution. So once the fixed and variable costs are segregated, they are differentiated, it becomes possible to calculate the total contribution as well as the total contribution per unit. What is contribution? Sales minus variable cost. So when you will recall that total contribution equals the difference between sales and variable cost, then the total contribution per unit is expressed in per unit terms. How to express it in per unit? We divide both sales and variable cost by the total number of units. We know how to find it. It's a unitary method. If you want to find 1 unit price, we divide with the total numbers. So total contribution is the contribution of sales revenue to fixed cost recovery and profit after meeting the total variable. What is break-even point? Break-even point is the point where we reach at no profit, no loss. If the total cost of production is rupees 100, then What is our sales? Sales is also 100. So 100 minus 100, result is 0. So when the profit or loss comes to 0, there is neither profit nor loss to the organization. That point when the organization reaches is known as break-even point. Am I clear? So we need to find out the break-even point, because when we start selling the goods, in the process of sales, the first stage that we encounter is the break-even point. We need to sell at least to the point where it is break-even, so that it is not causing any loss to the organization, if not profit. But if we are below the break-even, then for sure it is a loss to the organization. Now, once we reach the break-even point, from here, our journey starts of profitability. As much as units we can sell above the break-even point, it is your profitability counted in terms of units and in the broader scale in terms of amount. So at this point, your total cost and total revenues are held in equilibrium. It is equal. Equilibrium means equal. No profit, no loss. Am I clear? Break
Yes,
even
ma'am.
is clear?
Yes, ma'am.
Yes, it is.
Usman, break even is clear? You said you missed
Yes,
it?
ma'am.
Okay.
Yes, ma'am. It's clear. But the issue is the in illustration
We will come
9.1.
back to it, okay?
Okay,
The
okay, no problem.
calculation 10%, 20%, that one.
Yes,
Okay.
ma'am. Of course,
Once we
it
finish
is.
this, we'll come back to that, okay?
Okay.
So next, it is margin of safety. You can understand from the heading only what is margin of safety from the topic. A certain margin where safety is reached. So while revealing the estimated profit or loss at different levels of activity, where anyone can fall before a loss is experienced. This is known as the margin of safety and is obtained by deducting the break-even sales from the planned sales. You have a planned sales. What is planned sales? 1000 units. And what is your sales? Sales is, suppose you say 800 units. So 800 units minus 200 units, 800 units minus 1000 units, the 200 units that you have, it is your margin of safety. Am I clear? Again, I am repeating. There is a planned sales, budgeted sales. So when we go with planned sales minus margin of safety, how to come to the margin of safety? It is the planned sales minus your actual sales. Your planned sales is 1000 units and your sales is 800 units. So when you have planned sales and actual sales, then the difference is your margin of safety. Am I clear?
Yes.
Yes, you are clear.
It's
Yes,
only
ma'am.
it's only an principle, okay? In actual, it may be differing. It's only a principle which we follow as a security measure. Okay, so margin of safety, it is the difference between the actual value and the planned one or market one. So before a business reaches its break even point, how much output or sales level can you bear, can you achieve? That is margin of safety. We will not go with the graphical representation, but definitely we'll come to the. There is no need of these charts. Now, these are the relationships, and we will now come to the formulas, the mathematical representation of CBP and break-even analysis. F, for interpreting the formula, we use these following abbreviations. FC, it is your fixed cost. C, it is contribution. P is profit. S is sales. PV ratio is profit volume ratio. B is break even point. MS is margin of safety. And VC is variable cost. Just go through these abbreviations, and then we will start with the formula. Is this clear? All these words or all these alphabets or abbreviation are cleared which are used. All these terms are familiar. Since 2 days we are talking about this only.
It is clear. It is clear.
Okay. Now if you see the first one, this is the first one. The formula for fixed cost. Fixed cost equals to contribution my profit. Contribution minus profit. Or else PV ratio multiplied by sales minus profit. So it depends upon the question that which type of information is available, whether you have been provided with PV ratio, sales, profit, contribution. So according to the need of the question, according to the need of the formula, we have to apply the formula for fixed cost. Basically, in the general term, fixed cost is contribution minus profit. Coming to the second one, second formula is for what is contribution. So if fixed cost is contribution minus profit, then if we reverse it, contribution equals to fixed cost plus profit. Contribution is fixed cost plus profit. Am I clear?
Yes.
Or
Yes.
we can
ma'am.
say profit volume ratio multiplied by sales. The third one, it is very small printed. I am highlighting it. It is break-even point. Break-even point, we take it out in terms of value and in terms of units. When it is in terms of value, that is in terms of amount, what is the sales amount? It is in terms of value. And if we need to find out how many units we need to sell to reach to that point, it is your in terms of units. So in terms of sales value, break even is fixed cost divided by contribution multiplied by sales. Again, I am repeating, break even equals to fixed cost divided by contribution multiplied by sales. Or alternatively it is fixed cost divided by PV ratio And PV ratio, it is 1 minus VC, variable cost, upon sales. And when it is in terms of units, it is fixed cost divided by contribution per unit of product. Then coming to the fourth one, what is MS? Can anyone recall and tell me? What is the fourth
Margin of
formula?
safety.
Very good. MS is margin of safety, and margin of safety equals to sales minus break-even point. Sales minus break-even point. Next, it is profit. Profit is contribution minus FC, or PV ratio into MS. Margin of safety ratio, it is profit divided by profit volume, or actual sales minus break-even sales divided by actual sales. So this is all the formula. Just go through them because I will be scrolling down to the question. Just go through it. Can I scroll down? Yes, Harun,
Yes.
you want to say something, Harun? I can see your hands. Yes, Harun. Okay. So I'm scrolling down.
Yes.
This is the data for a particular accounting period. Sales is 20,000. Variable cost is 12,000. Okay. Sales 20,000. Variable cost 12,000. So what is the contribution? Contribution is sales minus variable cost. Yes, you remember? Sales minus variable cost is your contribution. So 20,000 minus 12,000, you can see contribution is 8,000. And when you add, when you include this fixed cost, that is 6,000. So contribution minus fixed cost is profit. Contribution minus fixed cost is profit. So what is your profit? 2,000. How to find PV ratio? PV ratio can be on the basis of contribution divided by sales. So 8,000 divided by 20,000 multiplied by 100, your answer is 40%. Okay? Till this it is clear.
Okay.
Just go through this.
Yes.
Okay? So before we proceed to the next, just write your names for attendance in the chat box. Okay? Otherwise, I will forget to say.
Okay, we have already.
Okay, if anyone has missed writing your names for attendance, please provide your names in the chat box, or anyone who has joined late. So this 40% is clear and profit of 2,000 is clear.
Yes, ma'am. And
Okay.
that PV ratio, we are going to multiply it by 100
We are going to multiply
in
it by
order
100 because it is expressed in
percentage.
percentage.
Okay, ma'am. Thank
Okay.
you.
Okay. So now when we come to the next one, This is already done. Now they are saying the units manufactured and sold is 10,000. The units manufactured and sold, it is 10,000. And with this units, these are the following changes which have been planned. When we go with 10,000, then the fixed cost increases to rupees 7,000. There is an increase in the fixed cost by rupees 7,000. Selling price per unit reduced to rupees 1.5. Rupees 2,000 minimum additional profit is required for the additional fixed cost of 1,000. That means there is an additional fixed cost of 1,000. And extra profit is also required, and this is put as rupees 1,000. Extra cost is also required, extra profit, and this is put at rupees 1,000. So what will be the new PV ratio? What will be the new PV ratio? So they have given you the new PV ratio as 20%. Now, how to determine the level of sales? When given profit and when fixed cost and PV ratio are known. So you know what is given profit? Profit plus fixed cost divided by PV ratio percentage. So what is the given profit? Given profit, they are saying rupees 2,000 as additional profit. So given profit is 2,000 and plus fixed cost. Here there is no fixed cost, they are saying. So what will be the fixed cost? From the above, it is 6,000. And PV ratio percentage, what was the PV ratio percentage in the first one? It was 40%. So when you divide this with 40%, you can see that sales level is 20,000. Now, if you want to maintain the current profit after an increase in fixed cost, current profit with an increase in fixed cost has increased from 6,000 to 1,000 plus, so 7,000. So what it will be? So from the given profit, this given profit will change to current profit. What is the current profit? So the current profit is, here you can see, 6,000 previous profit, additional 1,000 profit. So current profit is 7,000, 2,000 plus 7,000, current profit 2,000, 7,000 is your current fixed cost, and 40% when you divide, your answer is 22,500. So this time your sales volume is 22,500. So contribution is what? 40% of 22,500. Contribution equals to 40% of 22,500. So it is 9,000. 9,000 is your contribution. 40% of 22,500 is 9,000. And what is fixed cost? 7,000. So 9,000 minus 7,000. So your profit is 2,000. You said this only. If you go with the question, see, rupees 2,000, which I have highlighted, is the minimum additional profit you require. So when you increase the additional fixed cost by 1,000, then when you do the calculation, you get a profit same as desired. Am I clear?
Yes.
Okay. So to earn a minimum return on a new investment, we need to find current profit plus minimum return on additional profit plus new fixed cost divided by PV ratio percentage. So 2000 is your current profit, additional profit 2000 plus 7000 divided by 40%. Answer is 27,500. So 27,500 of 40%, 40% 27,500 is 11,000. Fixed cost is 7. So profit is 4,000. It is only the application of the formula which you have to learn. Okay.
Okay.
So these are all the applications. And with this, we come to the end of this one, cost volume profit analysis. The keywords that we have learned today is CVP analysis, cost volume profit. What it is, a change in the fixed cost and variable cost is going to bring a noticeable change in your profit. Break-even point, the level of sales where your total cost is equal to your total sales or total revenue. Margin of safety, it is your break-even minus sales. Margin of safety ratio, it is the formula. PV ratio, it is the percentage of contribution to sales. PV ratio is the percentage of contribution to sales. If the percentage is 20% of contribution to sales, that means it will be 20% of sales. Variable cost ratio and mixed cost. Mixed cost, initially it is variable, but later it is fixed. So these are the self-assessment questions. These are all same that we have discussed. Please go through them and go with the questions, basically the practice one. Not very difficult, but at least how to calculate fixed cost, contribution, sales, variable cost, margin of safety, and break even with PV ratio. Am I clear?
Yes, ma'am.
The next topic is budgeting and budgetary control. It is very easy. Budgeting, and those who are working, they know what it is. Budgeting and budgetary control is preparing a budget. When we are working in an organization, we need to prepare different types of budget. Even when we talk about the country comes up with the union budget, the country has its own budget, the state has its own budget, even the household people are having their own budget. When we earn, we maintain our own budget, the individuals have their own budget. Only what differs is the volume of budget. For a country, it may be in millions and billions, and for us, it may be only in thousands or lakhs. So, budget means it is a planned way to find out your revenues and your expenditure. On the basis of your revenues, on the basis of your receipts, you try to allocate the expenditure. Am I clear? Budget, it is a forecasting. Budget is a forecasting. It is a financial planning. We forecast that how much is going to be our income in the near future. And on the basis of that income, we try to allocate the expenditures. Am I clear?
Yes.
Okay.
Yes, ma'am.
Can I have a break of 2-3 minutes? I need to drink water.
Yes.
Okay, just 2-3 minutes.
Okay. Hello, Harun. Can you please put down your hand? Osman, your this thing is noisy. Please maybe you can reduce your.
The session is stopped. I don't know whether it's from me or is the technical issue from the madam.
No, she takes break.
Please, can you repeat? Let me rejoin again.
Can you listen to me?
Yes, ma'am.
I don't know how I was out of the meeting. Okay, I have to again upload. Can you see this?
Yes,
Okay, so I was talking about budget. So we are starting it. This is a very simple one, very easy. This is a part of financial planning. I told you we are forecasting that where we are going to have, we are going to just note down that what are the areas from where we are going to have our receipts and what are the areas where we are going to use those receipts. So, what is a budget? It is a plan which is expressed in quantitative, usually monetary terms. It is prepared for a specific period. It starts with a particular date and we end it with a particular date. It may be for a month, it may be for a week, or it may be for a year. What is budgetary control? Budgetary control means that it is a system of planning. If we have budget, we can closely monitor our expenses. We can exercise control on in the organization. We know the areas where we have to spend it. We know the areas from where we can have our income. We can have our receipts. So the process of budgetary control, it is including preparation of various types of budgets. It may be a performance budget, it may be your sales budget, it may be cash budget, it may be your inventory budget. So for each type of activity, we may have budget. What is the basic idea behind having a budget? A planned one and the actual one. And when there is something which we have planned and there is something which is actual, the difference is known as variance. The difference is known as variance. So each and every organization, they have their budgetary control system. There is a budget committee who prepares the budget, and the budget is prepared for a fixed period. The key factors which are included in the budget are sales, cash, the people who are working. So we need to make a forecast. It's a forecasting activity. While preparing the budget, we need to forecast the activities. We think that these activities are going to happen, and against those activities, there will be an income or we are going to make the expenditures. There is a fixed budget and flexible budget. Fixed budget never changes, flexible budget changes with the period of time. So I come to the directly to the flow chart. This is the flow chart classification of budgets. The budgets are classified on the basis of time, function, and flexibility. As per time, we can prepare budget for long term, short term. The budget can be current budget. Sometimes we prepare budget on daily basis and rolling budget. That means if this year the activities are not completed, it can be carried to the next year. Rolling budget, the activities, the budgeted activities, if not completed in the current year, they can be continued in the next year. So this is on the basis of time. When we talk about on the basis of function, it is sales budget, production budget, cost of production budget, purchase budget, personnel budget, research budget, capital expenditure budget, cash budget, and master budget. Master budget is a budget which includes all these activities in one budget. Flexibility, as per already discussed, it is fixed budget or flexible budget. So this is what the format of budget. Every year, every month wise you have to prepare. You go through the format and practice it. I think this budget is a common thing. You have gone through it before also. This is very easy. One important budget I want to make you understand here, rest all the budgets you can read and understand. One is zero budget. Zero budget is a budget where we do not have anything as a budget. Whatever we do, that is our performance. Okay? Whatever we do, that is a performance. Nothing is forecasted. If you have a sales of rupees 10 lakh, that is only sales. You don't have any budget where you have anticipated that you may have a sales. So zero budget is the companies where they do not follow any budgeting process is a zero budget. Okay, just read. Read it.
Excuse me, ma.
I'm not able to present or say anything. I don't know, there is some problem.
Ma, hello?
Hussaini, are you saying something?
Yes, ma. So I understand that budget is being classified based on the three categories, right?
What you are saying?
Yes, under classification of budget. So what I understand is it's being classified into three
Yes,
uh,
we classify the
categories.
budgets on three bases: time, function, and flexibility. The budget can be
Okay,
long term, short term, current budget,
okay,
which is daily or
okay,
weekly, which is not for a
okay.
longer period, and rolling budget. Rolling budget is a budget that if you have prepared a budget for this year and you are not able to fulfill all the activities through that budget, then those activities can be carried forward for the next year also or next period also. This is your rolling
Yes,
budget.
ma.
Okay?
Yes.
Coming to the next, I told you what is zero budget. Zero budget is a budget where we do not prepare anything in advance. We welcome as and when it comes. Okay? So, like we have cash budget, sales budget, here all we anticipate the future. What can be in the next, that we try to work out and then do our activities on that basis. That means it's a planned one. But when we talk about zero budget, in zero budget there is nothing which is known as forecasted. Okay? So after this budget, there is the ratios which control the budget. The ratios are activity ratio, capacity ratio, and efficiency ratio. Activity ratio, they are based on hours of production. Capacity ratio, efficiency ratio, they are based on actual hours worked. So we knew, as per the budget, we need to find out that how many hours the workers are working, what we have planned, are there any variance. So these activities can be the differences, the variation can be find out through the basis of the ratios. There is a performance budgeting also. What you expect, suppose, take an example, you expect that there will be a profit of 10 lakh rupees in this year. Now we try to reach that goal, a profit of 10 lakh. So we prepare a budget for how to achieve this 10 lakh profit. So this has to be as per the programs, activities, projects. So these functions has to be incorporated in some written document. And then we work. The countries, they go on working for GDP. They think that we will be having a growth rate of 7%, 8% GDP. And then at the end of the year, they come to know what is the growth rate. It can be more than the expectation or it can be below the expectation. This is the zero budgeting which I wanted to show you. So what is zero budgeting? In this process, generally assumes that the allocation of financial resources in the past was correct and will continue to hold good for future. Whatever was previous simple, it is going to be future. So we do not make any future plans. We take the previous only. There is nothing which is known as anticipation. So this is all about budgeting. It is all about the preparation of budgeting. There are different formats of budgeting. You please go through the budgeting formats. Okay? And one class we will have where you will be discussing your doubts before your exams. That Smriti madam will let you know. So before that class, before your exams, you need to do all the assessment questions which is given in your chapters. Am I clear? And coming to the last one. Last one is financial statement analysis. Achha, the last one is variance analysis. I told you what is variance. Variance is the difference between the actual and the planned. Whatever you have planned, whatever you have budget, and what is the actual. So the actual is known as standard. Okay. So what are the factors which are responsible for variance? Suppose you can produce 10,000 units at a given point of time, and at that period of time you are producing 9,000 units. So there is a variance of 1,000 units. So this difference of 1,000 units is known as variance. We need to find out that why this variance is, what are the reasons for this variance, and how we can check this variance. This variance can be in the cost, this can be in the materials, this can be in the labor, this can be in the overhead, that is the expenditures, it can be in sales, it can be in the control part. So all the variances that we call as differences or variation has to be reported to the management. So we need to prepare a variance reporting, and then we need to project and find the reasons of variance. So the variances are classified in two groups: cost variances and sale variances. Any activity which is related to cost, like labor, material, working hours, these are cost variances. And when we talk about sales variances, the expenditures related with sales are your sales variances. Okay, so I hope variance is clear to everyone. It is simple. Total
Yes, ma'am.
standard minus actual. What is expected and what is actual. The difference is variance. Okay, it can be in labor, it can be in production, it can be in sales, it can be in cost, it can be in direct material purchase, indirect material, it can be on any other expenses which we called as factory overhead, cost overhead, or sales overhead. So everywhere we need to find the actual and the standard. Okay, I just want to come to the key terms. There is a variance in sales also. What you have budgeted, what is your standard? You have budgeted 10,000 units of sale and there is a sales of only 9,000 units. So sales variance is actual budgeted sales minus actual sales. Sales volume variance, volume is always used for quantity units. You had expected units 500 units and the sales is only for 400 units. So it is sales volume variance. Sales variance is in terms of money and sales volume variance is in terms of units. So this variance reporting, we need to report the variances, the causes. Variance is simple deviation from the standard to the actual. So these variances, these deviations, these differences should be reported to the management on regular basis, and we should take corrective measures for its immediate recovery. If the variance is in the positive side, it's good, but if it's in the negative, then the measures had to be taken immediately. The person or department may be held responsible for any adverse variation after duly accounting of it. If there is a variance in the stock, what was supposed to be and what actually is found, then that is something which the storekeeper or the in charge has to be held responsible. So some variances are not only operational variances, but some variances are because of some mishandling of the products also, mishandling of the things also. So we need to identify the department from which the variance has occurred, and we need to held responsible those persons or those department. So this is the summary of all. Yes, the keywords direct labor cost variance when you are using direct labor for production. So, what cost you had expected and at what rate you are getting the labor. Direct labor cost variance means the wages that you have to pay for hiring of laborers. Direct labor efficiency variance, efficiency means their output, the hours that they are working. Then direct labor rate variance, the rate at which they are available. There is a standard rate available for laborers in the market, and then what specified wage you are paying to them. What is the actual rate paid and what is the standard rate available. At times, when there is a need, there is a production, you have a bulk order, and there is a shortage of laborers in the market, we hire them at more than the standard price. The standard price of the labor may be 500 rupees per day, but at times you have to pay 800 or 1000 also, because there is a shortage. So why this variance is there, why this difference is there? This is variance reporting. Direct material price variance, direct material price variance means the price at which the raw materials are available. Direct material is your raw material. Direct material usage variance, you are using the materials once it is purchased and stored in the storeroom. Now, how much material was supposed to be used for a particular unit of production and how much you are using it. Fixed overhead cost variance, it is fixed cost. Fixed overhead expenditure variance, that what is the expenditure for fixed overheads. Same way, overhead cost variance, sales price variance, sales price expectation and the actual sales price that you can get from the market, sales value variance, sales volume variance, sales value in terms of money, sales volume in terms of quantity, units produced. Variance already explained, 100, it is the budgeted performance and the actual performance. Variable overhead cost variance, the difference between recovered variable overheads and the actual variable overheads. So these are the basic terms we will come across, and for each and every variance there is a formula. You need to try those formulas for doing the practical questions. So this is all from my side for third block. Tomorrow we will be doing the fourth one, and then later on a class will be allotted for fifth block, which will be informed later. So now it's from your side. For all the variants, the definition of the meaning remains the same. Budgeted minus actual. Budgeted may be used as standard. So budgeted minus actual is your variance. Yes, you need anything to say? Nothing?
Ma'am,
Usman, I have come to that page which you were asking.
yes,
9.1.
ma'am. Yes. I'm asking about the calculation on break-even point Rufi cells.
Okay.
Yes. How can I calculate and get the figures here?
Okay. Others?
This session was very clear for me. Thank you so much.
Okay, thank you so much, Chipulumatso. Others, anything else?
It's okay, madam. Thank you.
Okay.
It's okay, ma'am. I missed the last unit of the session, but if I get the recording and go
Yeah,
through
yeah,
the
recording is there. I think Smriti ma'am is going to forward you the recordings, okay? And if
yes.
not, then I will forward it in this chat box. From there, you can download it in your system.
Okay, thanks.
Ma'am, I have a question regarding to budgets, types of budgets.
Yeah, go ahead.
Yes, I can just take an example in Malawi. In
Okay.
the finance department, we have the difficulties whereby there is devaluation about, I can say, 45%.
Food
We
per
made some budget. Yes, we made some budgets.
for footfall.
And I'm saying, like in Malawi,
Yeah.
we had, yes, we had a situation whereby
You have
we
a
had
restaurant. What you have?
it's a scenario which I want just to grab the aspect from you.
No, no.
Like in,
In
yes,
Malawi, you have prepared the budget for which sector? Is it a
no,
restaurant?
yeah, I'm talking about the private sector. I want just
Okay.
to have an
Okay, okay,
insight.
okay, okay.
Yeah. Okay, we prepared some budgets.
Hmm.
Then later on, after presenting the budgets to management, they were
Okay,
following all the procedures of assessing whatever the output, the variance, and the like.
okay,
But because of the effect of economic crisis that is in this year,
okay.
I mean last year in June, we had a devaluation of 45%. Then now, in this
Okay.
scenario,
Yes, please proceed.
how can we accommodate
Yeah, Godfrey, continue.
the
See, what
devaluation in
happens
our
now?
budgets? Because this now
Budget is what?
has turned our budgets.
Okay, I got what you want to say. That you had a budget, and due to some economic crisis facing this year, there was a variation of negative 45%. Okay, so what we should do in such cases? See, if you take previous 3 4 years, or if you take the period soon after the COVID, then you will find that everywhere there is a variance. And what was expected, especially in those 2 years or 3 years, what is expected and what we have achieved, there is a lot of difference. It is not only that we are facing in the private sector companies, public sector companies, even the government is facing this variance. And when it comes to government sector, this variance is known as deficit budgeting. Okay, because they have planned a revenue, and against that revenue they have planned certain expenditures, the allocation of those revenue to different priority sectors. So when there is a difference, they call it a deficit, and then they try to Kipilo Matsu, please mute yourself. And then when it comes to government, what happens? They try to make over this deficit with the help of borrowings and other sources. But as an individual or as a company, if we find that there is a variation, what is planned and what actually happened, then we have to again reallocate the resources. We had planned the resources for a profit margin of 10,000, 20,000, but actually, when we are not able to perform that, then we need to work on the actual one. And the variance, if it is just because of economic crisis, we need to report it to the management. What is the basic idea for performing or preparing this budget is that, is it really, it is due to inflation, it is really due to economic crisis, recession, but there may be some other reasons also. It may be due to wastages also. Suppose you take the material variance. In material variance, in many of the cases, you will find that it is because of wastage. We are not too much concerned about the raw materials that we issue from the store and how much it has been used in the factory. There are people who may mishandle, there may be wastage, there may be scrap, there may be spoilage. So variance is studied in this sector to understand that it is overall effect or it is only because of few people or few department. Am I clear, Godfrey? Where is Godfrey? He's there?
So you can continue, ma.
Okay, I think Godfrey is not there.
Yes.
Okay. So shall I end the class?
Yes, ma. It is time.
Okay, it's time. There is no hard and
Yes, ma.
fast rule. We can continue also if the things are not clear. Okay.
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 Thank you. Good night and thank you everyone. See you tomorrow. Okay.
Thank you, ma.
Thank
Goodbye.
Thank
Good
you.
night, madam.
Good
See
night.
you. Thank you.
Let me finish. I'm finishing. Can you see? Everyone's saying goodbye. Come see. Hey, can you stand up and see?